Okay, treasury stock. Companies buy shares of other companies all the time, but when they buy their own shares, they are called bump 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 treasury shares. And it's a stockholders equity account. Stockholders equity account. And it has a debit balance, which means it reduces stockholders' debit balance, which means it reduces stockholders' equity. All right. So instead of debiting an asset account, as we would when we buy equity from another company, we reduce stockholders' equity. Um, just briefly, why does this happen? You can do it to block a takeover attempt to try to drive up your price per share and make the takeover attempt unattractive. For compensation programs, it's a big reason to do it. Um, so a lot of stock is purchased by the company just to give it to management for stock option compensation. To manage earnings per share, and this has been documented in the accounting literature, if you can't adjust your net income in the numerator, what some firms might time their repurchases to hit earnings per share targets. Another reason, and this is more true of smaller companies, to make a market in the stock. If you're a local community bank, you might get approached by an owner of some shares who wants to sell their shares. Then the bank may buy the shares, but they may then also look for someone else to issue the shares to. Okay, that's making a market in your stock when you buy your shares for the purpose of selling it. Okay. Um, so there are officially two methods: cost method and the par or stated value method. We're going to do the cost method. So you're responsible for this quantitatively. The par or stated value method, um, you just should know that it's in compliance with GAAP and there's nothing wrong about it. It's just the cost method is more widely used. Okay? So what happens in the par or the stated value method? You essentially undo um, the par value and some additional paid capital, and it's a reduction in capital stock. So stockholders' equity is reduced by reducing those contributed capital accounts. In the cost method, we're going to have a separate account, a treasury stock account. So it's better from the perspective of it's a little more transparent, it's easier to see the treasury account activity. All right, so example 7, Pujols issues 10,000 shares of common stock on February 14th of FY1. That's not a treasury stock transaction. It's just trying to set the history for you. So on March 15th, for the first time in its corporate history, and that's important because it's telling you two things. One, that there's nothing else in the treasury stock account, and also there's nothing in the paid in capital treasury stock account. But they buy back 3,000 of their own shares, market price 10. And what we're going to see with the treasury stock method, it's really a cost method. It's like inventory. You're going to put it in at cost, and then when you remove these shares, they're going to come out at cost. So these shares are going to come out at $10, but they're going in at $10. Okay, so there's a buyback, and then on April 1st, they're going to sell 500 of those treasury shares when the market price is 14. So that's not bad. They bought low at 10 and they're going to sell high at 14. But once again, the corporation really shouldn't care because they're not so necessarily supposed to be in competition with their owners. Whatever this activity is in the treasury stock account is supposed to be serving the owners of the corporation. And then the next transaction is on April 15th. They sell 2,000 shares. So they had purchased 3,000. They sold 500. They sold 2,000, excuse me. There should be 500 left. In this case, the market price was $8 per share. So that's going to end up, you bought at 10, sold at 8. That's going to end up reducing stockholders' equity. But we're not going to see losses, and we won't see expenses, revenues, or gains here. The transactions between the owners of the corporation and the corporation do not result in revenues, expenses, gains, and losses. All right. And the last question that's asked, so we're going to record all these, and it says if they don't enter into any other stock transactions, what's the ending balance of treasury stock and how many shares? And I think just talking through this problem answered that question, but we'll go through it. So first of all, they purchased treasury stock, and as I mentioned, it's really kind of like inventory accounting in that, where's my pen? There you are. It was 3,000 shares at $10 per share. Okay. And that's where the 30,000 came from. In the second part, it was how much cash did they receive when they, so in the first transaction, A, they're buying the shares, and B, they're selling it. So they're receiving cash 500, and if I remember correctly, and I can see it right up there, it was $14 per share. Oops. So that's where the 7,000 comes from. But when we take it out, we're still taking out 500 shares. Take it out at cost, $10 per share, and that's a zero, believe it or not. That's where the 5,000 comes from. Now, if this account weren't here, you would know, being good accountants, that you'd have a $2,000 debit. That little button thing. Okay, you'd have a 2,000. Oh, sorry guys, I need to get smaller fingers or a different pen here. All right, so this is a plug number. It's a credit to stockholders' equity. So you might think of it like a gain. If you were a trader, you'd say, "Hey, I bought this stock for 5,000, sold it for 7. I have a $2,000 gain." But once again, this is a company trading in its own stock, so we don't call this a gain because a company is involved in a transaction with its owners. So we just record directly an increase in a stockholder's equity account called paid-in capital treasury stock or treasury stock transactions. Okay? Seriously, I've got nowhere to hold this pen hardly. Okay, so let's look at the next transaction. This was 2,000 shares times, now it was $8 a share, and that's where the 16,000 comes from. Okay, so 2,000, whoops, times, whoa. Let me clean this up a little bit. That didn't work out very well. 2,000 times now our cost. What we take out of treasury stock is our cost, right? And that's where the 20,000 comes from. Now, we know we have a total of $4,000. So if we plug this, we know, we have to have $4,000 debit. But there's one other check you have to do. Let me put a T account up here for paid in capital treasury stock. Now, because we just started the company and these were our first ever transactions, we know the balance was zero. And paid in capital accounts do have normal balances, normal credit balances. We initially credited 2,000 on 4/1/FY1. We cannot have a debit balance. So the most that we could debit is 2,000. And that's this number right here. So if you exhaust paid in capital treasury stock, then you have to go to retained earnings. Okay. So the reason that retained earnings is 2,000 is a little bit of a coincidence. It's just half of what was in paid in capital treasury stock. All right. And they ask us how many shares are outstanding. What's the ending balance in the treasury stock account? Okay, there's a couple ways. We could do the T account thing. Treasury stock. So treasury stock, we started with 30,000. Let's see, we took out 5 and we took out 20. So there should be 5,000. The other thing to notice is we had 10,000, 3,000 shares minus we took 2,500 times $10 a share. So if we notice we had 500 shares left and they're at 10 apiece, that's also 5,000. Another way to look at it. Okay, and then what's the number of outstanding shares? We write the definition: outstanding shares equals issued minus treasury. So we've issued 10,000 and I just told you there's 500 left. So that's 9,500 are outstanding. Okay, that about does it for treasury stock. And that's everything you want to know, but we're afraid to ask about treasury stock. Really, this little retained earnings thing is probably the biggest, tricky thing you might forget. That if you exhaust paid-in capital treasury stock, you have to get the rest from retained earnings.